45 minutes, according to my pencil, end at 3:53. And I'll warn you 5 minutes before that, and then you'll in. Please begin.
Is the mic working? Microphone working?
Yeah.
Good. I was going to give my talk from down there, but then some of my points will be a bit controversial. So I thought I should sit closer to the door. Marxists have always argued that economic crisis stems from the basic workings of capitalism. We criticize neoclassical economics for the claim that capitalism is inherently stable, that crisis is due to an event external to capitalism, such as a big bank collapse, the start of a war, mistaken monetary policy. Marxists have argued that the neoclassical view is apologetic toward capitalism. It lets capitalism off the hook. However, this justified criticism of neoclassical economics has led some to think that a satisfactory explanation of crisis, especially severe crises, must be found solely at the level of capitalism in general. Since a big crisis shouldn't be due to contingent events or policy, the explanation must be found, according to this common view, by examining the fundamental contradictions of capitalism. In my view, there are 4, not 3, levels of analysis of capitalism. Analysis of capitalism in general, analysis of the particular form of capitalism at a given time and place, and then state policies and contingent events going from the most general to the most concrete. My paper does the following. It considers the role of each of the 4 levels of analysis for explaining a crisis, arguing that level 2, the particular form of capitalism, plays a central role in determining which fundamental capitalist crisis tendency causes a particular crisis. Second, it offers an explanation for the crisis that began in 2008 that demonstrates the role of each of the 4 levels of analysis. And third, if there's time, which there probably won't be, I'll evaluate the approach that I'm advocating to economic crisis. Now, John Weeks argued that we should reserve the term crisis for a severe episode of blockage and accumulation. In my view, while I agree with John that we should clearly distinguish short-run business cycle recessions from a longer-lasting, more severe occurrence, they both deserve the term crisis. So I think the best terminology is short-term or short-run crises, which involve a downturn in production, profit, employment that usually lasts 6 months to 2 years, at least in recent times. And the internal mechanisms of capitalism tend to resolve such a crisis eventually. But a second type is the long-run or structural crisis, which typically lasts 5 to 10 years. But it's not just differentiated from the short-run crisis by its duration. During a long-run crisis, there can be periods of expanding economic activity, such as 1933 to 1937 in the U.S. economy, when the economy expanded continuously. A long-term crisis or structural crisis involves stagnation, or possibly a slight decrease over a long period of time, but with ups and downs during it. Third, perhaps the most important feature of a long-run crisis is that it cannot be resolved by internal mechanisms of capitalism, but requires economic restructuring if normal accumulation is to resume. That justifies use of the term structural crisis. Examples, in my view, are the 1870s to 1890s in Europe, the 1930s, and I place the 1970s in that category as well. Each of those episodes was resolved only by major restructuring of capitalism. The current crisis appears to be another structural crisis of capitalism, at least in part of the capitalist world. It has been pointed out that it has not affected the entire globe. Since the end of the initial downturn in the summer of 2009, the US economy has been stuck in a very sluggish expansion while Europe is in deep stagnation for 6 years. So how can we explain a structural crisis? In my view, and of particular importance, how can we see a structural crisis coming beforehand? The starting point, I think, is indeed the Marxist theory of capitalism in general. That gives us several crisis tendencies, not just one, that emerge from the contradictions of capitalism. But analysis at that level cannot tell us which of the various crisis tendencies is tending to cause crisis at a given time and place. We also need to know whether the operative crisis tendency, whatever it may be, is leading toward a short-run or a structural crisis. In my view, you cannot answer those questions by analyzing capitalism in general. One approach is to supplement an analysis of capitalism in general with a look at the data. Is the profit rate falling or is it not? Is the organic composition of capital rising or is it not? Is consumer demand lagging, etc.? Is there evidence of overaccumulation of fixed capital? The limitation of that approach, which has been pioneered by people like Tom Weisskopf, is first data problems. Problems with economic data that we're all very well aware of, their ambiguity, make it difficult to reach definite conclusions because of the many different ways of constructing economic data. Second, this approach cannot explain why one particular crisis tendency rather than another is operating at a particular time. And third, this approach, capitalism in general plus data, is better for explaining after the fact than beforehand. The second step, in my view, after considering the crisis tendencies inherent in capitalism in general, is to look at the particular form of capitalism, not state policy or contingent events. That comes later. Capitalism has taken a series of distinct forms over time and space, and the particular form tends to last for an extended period of time. In my view, what defines a particular form of capitalism is particular economic and political institutions, an associated form of the dominant ideology, a form of bourgeois ideology, and a particular form of the main-class relations of capitalism, particularly the capital-labor relation. Now, every form of capitalism is still capitalism, a system of generalized commodity production, the wage-labor relation through which capital appropriates surplus value from labor. But these particular forms vary, and they go by different names in the Marxist literature. Stages in the earlier literature, social structures of accumulation, regimes of accumulation. Now, I would like to emphasize that there's a difference between a form of capitalism and state policies. A state policy is narrow and in principle subject to change at any time. By contrast, a form of capitalism is a coherent entity with mutually reinforcing elements. It has contradictions, but it does also have a certain stability for a significant period of time. A form of capitalism will give rise to particular kinds of state policies. The policies followed are constrained by the existing form of capitalism. Now, what role does the form of capitalism play in crisis analysis? The form of capitalism does not introduce new crisis tendencies that cannot be discovered by an analysis of capitalism in general. Rather, the form of capitalism is the main determinant of which crisis tendency will emerge and cause a crisis. And secondly, determines whether the emerging crisis will be a short-run business cycle recession or a structural crisis. State policies and contingent events also play a role, particularly in the timing of the crisis. Now, what I'd like to do next is discuss the current crisis, offering a particular interpretation of it which is found in an article I published in 2009 in Review of Radical Political Economics and developed more fully in my forthcoming book, optimistically titled The Rise and Fall of Neoliberal Capitalism, forthcoming with Harvard University Press, January 2015. And to continue the spirit of shameless commercialism, here is the cover that was chosen for it. They never consult the author about these things. It could have been worse, but obviously those should be $100 bills, not $1 bills. But what can we say? I put some leaflets about the book on the table here to complete the shameless commercialism. Now, in these works, I do not explicitly consider the role of these 4 levels of analysis. So that's what I hope to contribute here. Now, I will analyze the crisis as it developed in the US, where it originated. During 1979 to 2007, which I think is the best representation of the neoliberal era from business cycle peak to business cycle peak year to avoid distortions from the business cycle, there were 3 important economic developments. First, increasing inequality in the form of a large and growing gap between profits and wages, and increasing inequality among households. Second, a series of large asset bubbles. In the 1980s, in southwestern commercial real estate, in the second half of the 1990s, in the New York stock market, and in the 2000s in real estates. Third, a shift in the practices of financial institutions towards speculative and highly risky activities. Here we have the shift from the traditional financial practices toward the so-called financial innovations, subprime mortgages, mortgage-backed securities, collateralized debt obligations, credit default swaps. Financial corporation profits in the U.S. shot up during this period from 20% to 40% of all corporate profits by the early 2000s. And non-financial corporations shifted in the direction of financial activities, leading to the concept of financialization. Now, the above 3 developments led to 3 trends that were unsustainable in the long run. First, rising levels of household and financial sector debt. Households borrowed to finance consumer spending. Financial institutions borrowed to finance their very profitable activities. Both sectors' debt grew very rapidly over the period. Household debt in the U.S. doubled relative to household income over this period, in the neoliberal era, through 2007, while less noticed, financial sector debt increased 6-fold, from 20 relative to GDP, from 20% to 120% of GDP. The largest financial institutions' leverage grew very rapidly toward the end. Secondly, what has become known as toxic financial assets spread throughout the financial system, another long-term trend. These new types of financial assets had a value which at the end could be sustained only if the real estate bubble inflated forever. And it is in the nature of every asset bubble that eventually it will deflate. Third, less noticed, harder to prove, has been growing, over that period, was growing excess productive capacity. I have a figure that shows the industrial capacity utilization rate as measured by the U.S. Federal Reserve. In the last 2 business cycle peaks of the previous regulated capitalist era, industrial capacity use was quite high and it was rising from peak to peak. They didn't collect it for the peak before that. In the neoliberal era, the last 3 peaks, it was substantially lower and it was declining. I think this is evidence of a growing excess capacity in the economy. Shortly, I will argue that in addition to this visible excess capacity, there was a hidden excess capacity that was revealed on the eve of the crisis. Now, how did these trends lead to the crisis? Here's my research assistant's figure. Neoliberal institutions led to these three developments of rising inequality, asset bubbles, and financial institutions' risky behavior, and they in turn led to these three trends, as I've argued. Then the key event was the inevitable. Not a lot of things are inevitable, but the deflation of an asset bubble is inevitable, eventually. When that happened, it had the following effects. By the way, in the US, the housing bubble stopped growing in 2006 and began to deflate in 2007. First, households could no longer borrow against the value of their homes. They had to pay back their loans, and this led to a large drop in consumer spending. Second, as the asset bubble began to deflate, the deflating asset bubble, I believe, transformed the expectations, the profit expectations of those who controlled investment decisions, and they worsened, and that directly caused a decrease in non-residential fixed investments. But as consumer demand fell, that also pulled down non-residential fixed investments as sales were falling. GDP began to fall in the US in the first quarter of 2008. And by the way, I just looked at the data last night. While the percentage decrease in non-residential fixed investment was much larger than that in household consumption, the absolute fall in household consumption was significantly larger than the absolute fall in non-residential fixed investment in every quarter in 2008. So the bigger downward impact from demand on the economy in 2008 was from declining household consumption, not business investment. Only in the first quarter of 2009 did the absolute fall in business investment rise above, if you can use above for a negative number, that of declining consumer spending. Third, the deflating housing bubble caused a collapse of the value of the toxic securities, the market value. Together with the high debt of financial institutions, the result was the sudden insolvency of all of the major banks in the US, which set off the financial panic. In my view, the financial panic did not cause the Great Recession. So we have the real estate bubble deflates, it leads to falling consumption, falling investment, and financial institution insolvency. The financial institution insolvency leads to the financial crisis. These two factors lead to the Great Recession. Many analysts believe that the financial panic caused the Great Recession. In my view, it made it more severe, but it was not the fundamental cause. If it had been the cause, you would have expected to see interest rates go up. In fact, very early in the crisis, both the non-financial corporations and the financial institutions had huge cash holdings. And the non-financials were not using them for investment, and the banks were not making loans. That does not fit with a real sector crisis caused by the inability of the real sector to get loans from the financial sector. Many Marxist analysts, and even some Keynesians, would agree with all or many of the specific links that were in that nice drawing that my research assistant did, that I have on the screen a minute ago. However, there is not widespread agreement about how to interpret the causes of the starting point, the three developments, the rising inequality, etc., that led to this sequence. In my view, and here is the key argument, it was the neoliberal form of capitalism that explains the three developments that led to the three trends that led to the crisis. This could be a song, actually, I realize, of a round type. How the causal relations here are interpreted in relation to the four levels of analysis matters for our understanding of the crisis. For example, was the asset bubble and its deflation an inevitable result of capitalism? Was it a result of government policy? Was it a contingent event? I will argue that it was an outcome of the way neoliberal capitalism works. Now, how do I make that argument? There's wide agreement that the form of capitalism changed around 1980, after around 1980. However, there are different views about how to characterize it. The three main concepts that have been put forward by Marxist analysts are that contemporary capitalism is financialized capitalism, that it's globalized capitalism, or that it's neoliberal capitalism. My forthcoming book argues, it presents an extended analysis of this question, arguing that neoliberalism or neoliberal capitalism more properly best captures the form of capitalism in this period. In my view, globalization and financialization are best understood as features of neoliberal capitalism. They're important, but they're not as comprehensive a way of understanding how capitalism has operated in this period. But I will not go into that debate here, but will show how a particular concept of neoliberal capitalism can account for the developments that led to the crisis. The concept of neoliberal capitalism also explains the character of capital accumulation over the whole period. A number of people have argued we have to explain not just the crisis, but the character of capital accumulation in recent decades. And I believe that can be done based on an understanding of the neoliberal form of capitalism. The important policy decisions that occurred flow from the logic of the neoliberal form of capitalism. Now, what do I mean by neoliberalism? Some view neoliberalism as an ideology. John Bellamy Foster, for example, views it as an ideology. I think that's too narrow. In my view, it should be understood, neoliberalism should be understood as a form of capitalism embodied in institutions, ideas, and the main class relations of capitalism. I have a lengthy 3-slide table, which I think I should not spend too much time on. So, first, the dominance of neoliberal ideas. You folks know what all those neoliberal ideas are. I don't need to spend time on it. More important are the institutions, the global economy, free movement of goods, services, capital, money, a series of changes in the role of the government in the economy, renunciation of aggregate demand management aimed at relatively low unemployment rate, deregulation of both basic industries and finance, weakening of what's sometimes called social regulation, environmental, consumer product safety, job safety, weakening of antitrust regulation, privatization and contracting out of public goods and services, cutbacks in or elimination of social welfare programs, tax cuts for business and the rich. But it was not, has not been limited to the government. Neoliberalism is not just about the role of government. The capital labor, the institutions governing the capital labor relation changed. A ritualized collective bargaining was replaced by its marginalization, with employers simply setting the terms of employment, the casualization of jobs, replacing a relatively stable full-time jobs for most of the working class, and changes in the corporate sector as well. A relatively restrained form of competition among big corporations that prevailed in the 50s and 60s. I remember telling students when I first started teaching in the early 70s that, big companies never cut prices. Well, that changed in the neoliberal era. A much more intense, unrestrained competition. Corporate CEOs, instead of almost invariably being promoted from the inside, more and more came to be promoted from the outside. I give some data to support this. Market principles penetrated inside corporations. Financial institutions shifted toward new types of activities and became, in my view, relatively independent of the non-financial sector. Now, these institutions are not just ideas, they're not just a random list. They make up a coherent structure with mutually reinforcing parts that has some stability and durability. Why use the term neoliberalism? Well, it's a new liberal form of capitalism. Under neoliberal capitalism, market relations and market forces expanded greatly to play the predominant role in regulating economic activity. Non-market institutions, such as states, trade unions, corporate bureaucracies, even professional associations have played a reduced role. One of the curious things is that the institutions and ideas of neoliberal capitalism not only have promoted an increasing role for market relations and market forces, they have also reinforced the power of capital over labor. And the previous capital-labor relation based on relative compromise between capital and labor was replaced by quite full dominance of capital over labor. Even though neoliberal ideology it doesn't say anything about power relation between capital and labor, the effect of neoliberal institutions and ideas is to bring about a dominant position fully dominant position for capital over labor. Now, in relevance to analyzing the crisis is that the neoliberal form of capitalism has suppressed some capitalist crisis tendencies while reinforcing others. It has suppressed, because it strengthens capital's power over labor, the rate of exploitation tends to rise rapidly. And one of the papers, I think it was Simon's, showed a rapid increase in the rate of surplus value in the U.S. in the neoliberal era. This suppresses the falling rate of profit, the profit squeeze, and the profit squeeze crisis tendency. The best evidence shows that for the U.S., the long-term trend in the profit rates was up through the 2000s. And the data I think are best, it fell slightly after 2006, but not very sharply. Of course, what you get for the profit rate depends on what you put in the denominator. If you put enough stuff in the denominator, you can get it to fall steadily. Okay, the long-term trend in the profit rate after the early 80s, in my view, was up, then only slightly down at the end. Now, one might think that this form of capitalism would foster underconsumption. However, that overlooks the effects of the financial aspects of neoliberal capitalism, which led to consumer spending rising over the period relative to either disposable income or GDP. Underconsumption did not happen. Consumption was a rising share of output, not a lagging share in this period, because households were able to finance consumer spending increasingly based on borrowing. Was it a Minsky moment about which there was a lot of talk in the media? As I understand Minsky's model, it has to do with non-financial sector debt rising to a point where the non-financial sector can no longer service the debt after growth slows down a bit. But non-financial sector debt did not rise significantly in the U.S. in the neoliberal era. It's the one sector of the economy for which its debt rose only very slightly relative to GDP, while households and financial institutions' borrowings were growing up very sharply. The financial institutions did not focus on lending to non-financial corporations in this period. They engaged in other activities. In my view, the fundamental crisis tendency, one of several in capitalism, that was fostered by the neoliberal form of capitalism was the overaccumulation of fixed capital. A little similar to John Lucas's view, not identical. It's nice after all these years, John and I have come closer together in our crisis theory views, although I'm sure we'll find serious differences in the discussion. Now, first I want to show how neoliberal capitalism produced these three developments, and then explain how that led to fostering the overaccumulation crisis tendency. The three developments cited above, rising inequality, shift in financial institution behavior, large asset bubbles, first led to 25 years of relatively long, historically long economic expansions, relatively brief contractions, although the recovery was typically sluggish, a relatively stable capital accumulation process, but over time, these same developments were leading to a big crisis. First, rising inequality. Oh, by the way, I tried to find a graphic for overaccumulation of fixed capital. This was the best I could do. All the others just had money. This had real physical capital. So I read for this. Okay, how does neoliberal capitalism lead to these three developments? First, inequality. Most of the institutions of neoliberal capitalism fostered growing inequality. The open world economy that put workers all over the world in competition with each other, the abandonment of aggregate demand management, which resulted in a higher average unemployment rate, a bigger reserve army of labor, the deregulation of basic industries, which had been relatively high-wage industries, soon wages collapsed as they were deregulated. Privatization generally led to cuts in wages. Social program cuts obviously made the poor worse off. Tax cuts for business and the rich. All of these. One interesting one is the market for corporate CEOs. That's what enabled CEO pay to skyrocket from about 30 to 1 relative to the average worker in the 70s to more than 200 to 1 as corporations competed for CEOs in the markets. Corporations with multi-billion-dollar profits that CEOs could bargain for a share of. Relatively free markets promote rising inequality as the strong, the quick, and the unscrupulous grab a rising share of the value produced. The institutions that can, they don't always, but that can reduce, either stabilize or reduce inequality are states, trade unions, even corporate bureaucracies under certain conditions, job ladders. What produced the shift in financial institution behavior? Well, the one factor usually cited is financial deregulation, which in my view was part of the neoliberal transformation. But that is not the whole story. Intensification of competition put pressure on the biggest old-line banks to shift in favor of speculative activities despite their hesitations. Hiring CEOs from the outside meant that the CEOs in the financial sector were trying to pad their resume for the next couple of years so they could shift elsewhere. It made them more attuned to immediate profits and led to the next factor cited, the shift toward short-run profit-seeking behavior. The rise of the free market theory of finance, which assured the actors that all of this was very stable, in fact was stabilizing. The promotion of a culture of pure self-interest rather than serving the corporation. My colleague Jim Crotty has written very interesting articles about the growing disjuncture between the traders in the financial institutions and the fate of their employer over time, as the traders made huge bonuses by making bets that would enrich them, but eventually drive the company into bankruptcy. Third, asset bubbles. Sometimes you hear that asset bubbles are a feature of capitalism, but they don't occur all the time. There were no asset bubbles, no big asset bubbles in the U.S. between the end of World War II and 1980. Then they started with great regularity in the 1980s. Asset bubbles are stimulated by neoliberal capitalism because, first of all, growing inequality meant a growing volume of flow of income into the hands of the rich and large corporations, which exceeded the available productive investment opportunities. This led some funds to find their way into assets, which would tend to start the price rising. But it's difficult to have a big asset bubble unless there are financial institutions that are ready and eager to lend to speculators in assets or even engaged in the speculation themselves. And the speculatively oriented, risk-seeking financial institutions of neoliberal capitalism were indeed eager to do just that. By the way, asset bubbles can arise in other forms of capitalism. Chinese capitalism, I agree it's capitalist now, since about the 1990s, Chinese capitalism has produced a huge asset bubble in its cities, even though it's not a neoliberal form of capitalism. Somewhat different dynamics are driving that in the Chinese case. But the neoliberal form of capitalism is very prolific at giving birth to bubbles. Those three developments, as they emerged from neoliberal capitalism, led to a long period of of stable capital accumulation. As the economy expanded, the institutions of neoliberal capitalism would bring in each expansion rapidly rising profits, a strong incentive to continue accumulating. However, continuing accumulation requires that someone buy the goods, and it is difficult for accumulation to realize itself indefinitely. There must be other parts of the demand besides the purchase of means of production. The aggregate demand problem that neoliberal capitalism produced was resolved by risk-seeking financial institutions together with asset bubbles, which enabled large-scale borrowing by households to support growth of consumer demand. I'll give you examples from two such loan expansions. In the second half of the 90s, in 1995, the expansion in the US had already been going on for in its fifth year when the stock market bubble started. And as a result, in the last 3 years of the 90s, upper income households, those in the top 20%, thought they were getting rich in the stock market, and there was a very unusual, huge acceleration in consumer spending growth. It grew over 5% a year for the last 3 years of the 1990s, and that is what prolonged the expansion and accelerated it to the point at which the unemployment rate actually got relatively low. It was the longest continuous expansion on record in the US. In the 2000s, an even bigger bubble, this time in real estate, provided an appreciating asset that a much larger part of the population could borrow against. So despite stagnating real wages, workers were able to maintain and even increase their consumer spending. I think there are some problems with the inflation indexes, the price indexes, that what may appear as rising consumer spending for much of the working class was actually maintaining their living standard in the face of a mix of necessary goods whose prices were rising faster than the average, such as healthcare and some others. The low and stable price inflation of this period, I think, has been due to the intense competition of neoliberal capitalism, the tendency toward excess capacity, and very low worker bargaining power. Now, which crisis tendency does this amount to? I forgot to switch to this. That's what I just said. That's just my research assistant says it better in these bubbles. Neoliberal capitalism promoted the capitalist crisis tendency of overaccumulation of fixed capital first because the big asset bubble directly stimulates investment in fixed capital. It promotes exaggerated expectations of future profit rates. That's more true with the stock market bubble, but even true with the real estate bubble, which creates a sense of euphoria among corporate officials. Secondly, as the asset bubble stimulates consumer demand, firms respond by increasing their productive capacity so they can sell to and profit from the rising consumer demand. But that rising consumer demand is more and more based on consumer spending that is not backed up by ordinary consumer income growth. It's a result of consumer borrowing. I have data from 2004 to 2006. I remember the years right? Yeah. Withdrawals from household equity in the U.S. amounted to, I believe it was 15% of household disposable income. But I hate to quote numbers from memory. I think I have it right. If I have it wrong, I'll tell you later. Once the asset bubble burst and consumer spending fell to a normal relation to consumer income, then much of that fixed capital turned out to be excess. And so this is what I referred to before as hidden excess capacity. By the way, this happened in 2001 after the stock market crash. There was a 3-year-long first rapid decline in non-residential fixed investment and then stagnation in the third year in the U.S. because of the collapse of the stock market bubble. But then the economy was rescued by the real estate bubble. The role of individual policy decisions. They played a role In 1999 to 2000, someone in the regulatory apparatus in the Commodity Futures Trading Commission wanted to regulate derivatives. And Lawrence Summers, then Secretary of the Treasury, was able to prevent that from happening, inserted a measure into the last Bank Deregulation Act of the period that forbade any regulation of derivatives. That played a role. If derivatives had been regulated, perhaps the crisis in the financial sector wouldn't have been quite as great. In 2004, the Securities and Exchange Commission was asked by the 5 biggest investment banks to eliminate the lid on their leverage ratio. They said, we're so sophisticated that we don't need a limit on our leverage. And the only opposition to this in the hearing was from an obscure computer programmer in Indiana who sent in a letter saying that the risk analyses that these firms were doing were invalid because they were not taking account of many securities going bottom up at the same time. Well, that wasn't listened to. The lid was lifted, and all 5 of them, of the 5 in 2008, 1 went bankrupt, 2 were acquired, and 2 had to be bailed out by the Fed. So if that hadn't happened, perhaps it would have been somewhat milder, but would not have prevented the crisis. The failure of Lehman Brothers, if Lehman Brothers had been more cautious and hadn't failed, perhaps the crisis would have started a little later. In the 3 minutes remaining, I'll just make some concluding comments that paying attention to the form of capitalism is, in my view, essential to analyzing crises. If that is not part of the crisis analysis, one is left only with an analysis of capitalism in general, plus policies and contingent events, which is not sufficient. One advantage of this approach is that it gives you a basis for making reasonably well-founded predictions about future developments. And I think from looking at history, from these theoretical considerations, from looking at how past crises of a liberal form of capitalism have been resolved, one can argue that there are 3 possible resolutions to this crisis. One, a right-wing, and that's why I entitled my book The Rise and Fall of Neoliberal Capitalism. I think this is the system crisis of neoliberal capitalism, and that it will soon pass away, and it may give rise to something worse, a right-wing, nationalist, and statist form of capitalism in which big capital runs the economy through the states, another round of a so broadly defined social democratic form of capitalism, or a transition to socialism. I'll give you 3 guesses which I favor. I think the possibility of a transition to socialism should not be discounted. In my view, this approach does not let capitalism off the hook, as some critics of the neoliberalism focus argue. I think we have to explain crises as we best can explain them. And if neoliberal capitalism is implicated, then we should pay attention to that. The recognition that social democracy is a possible resolution to this crisis, I think, is an admission of what is factually true. Now, the problem with social democratic capitalism is it will bring another 20, 25 years of relatively rapid output growth, global warming will be exacerbated, and human civilization will be sunk. The only direction of change, I think, that holds a future for humanity is the socialist direction, since socialism, I think, could provide a sustainable relation to the environment as well as its other well-known advantages. Thank you.
Thank you, David. You got in 15 seconds there. There are a number of issues that have come up that relate to what we're saying so far, and well, in the future. I just thought I might touch on them without commenting on them. I think they'd be worthwhile discussing. One, I think David's offered what might be called a new epoch approach, that is, that that neoliberalism represents a new epoch of capitalism, a new stage, a phase, or whatever word you want to use. And so we might want to discuss that, or whether it's changing government policies or what. Second point is finance wasn't the cause of the crisis, it made it worse. That's certainly something I think that several people want to discuss. Third, on regulations, weakening of regulations. I think some in this room have said that current capitalism is just as regulated as it was before. It's just regulated by the capitalists, and even by the state, but in a different interest. You might want to discuss that. Also, I think there's the issue related to that. David was the first one to use the term market forces and free markets, and we might want to discuss whether or not we, what we think about those terms. And finally, Minsky moment. David said he didn't think it was a Minsky moment. We might want to raise that issue. So having raised those things, and as I think might be topics to deal with, maybe not. Anyway, I'll now take people who want to discuss with David what he said. Yeah.
Yes, David, just by way of giving you a bit of extra time, can you just explain what's the difference between social democratic capitalism and transition to socialism?
Well, I think it's red versus pink. Seriously, to me, social democratic capitalism is a form of capitalism in which capital and labor compromise. There is an extensive welfare state. Workers have extensive job rights, such as one sees in places like Sweden. And there were milder variants of that in many developed capitalist countries in the decades after World War II. By socialism, I mean a system in which the means of production are socially owned in various forms of state worker ownership, cooperative ownership, and the economy is primarily guided by economic planning, although not necessarily the highly centralized form of the Soviet model.
Simon, oh, excuse me.
No,
you're next.
Thanks. David, I really liked your paper, and I agree with lots of it, but I just want to push on one particular aspect, which is what I think you meant by overaccumulation of capital. So you have an argument that debt-fueled consumer spending essentially led to firms' investments increasing, and then when the asset bubble burst, so the debt-fueled consumer spending collapsed, then firms suddenly found they had too much productive capacity. I think my question is that true? Well over 70% of the US labour force are employed in industrial sectors in which fixed investment's not really that important. So, you've got to show for your argument to work that it was the fixed investment in, crudely, the capital-intensive industries which drove what subsequently happened. And I'm just not convinced that's right. So I wonder if you could comment on it.
Well, it's true. I don't do a sectoral analysis in my work, but on the aggregate level, business fixed investment really did collapse. It was just a huge decrease between the beginning of 2008 and the summer of 2009. I believe it didn't. It took 6 years before it came close to what it had been on the eve of the crisis, and it does seem that is at the root of the sluggishness of the U.S. economy. There was a burst of stimulus from the federal stimulus program, and a little burst of exports actually for a while even. But once that wore off, it settled into 2.2% rate of growth per year. And I think it's because of I constructed a measure of capital accumulation. And it's been, off the charts. It's been about 0.5% per year, about less than half of its previous low points in the entire post-war period. So I think that, well, I don't know about how it has appeared across sectors. As a whole, business fixed investment has been very weak. Since then, it has not recovered. And by the way, the same thing happened in the 1930s. There was a big debate. Why is business investment so laggard? In 1939, business fixed investment was half what it had been in 1929. There was the same debate. One side, the right wing, said it was a result of the New Deal, which was scaring off the capitalists. And the left said, well, some problem was capitalism. And again, I think there's the same debate. The right wing is saying that the problem is the government deficit that's scaring off the investors.
I enjoyed your paper. It has always happens, as it always happens. Since I have a lot of themes in common with you, I have a lot of disagreements on the details. But I will not go into that. I just want to raise 3 quick points. The first is Minsky. I agree with you that if we look at the canonical Minsky's picture, there is this problem. And also those who said Minsky moment, etc., have the problem to explain the fact that the non-financial business sector was not in that before the crisis. The opposite. Even though not only the finance, but also the household sector was deeply in debt in the US. However, I would just say that if I would look at Minsky now, not in the mid-70s, I will stress 3 things. The stress on the interconnections between balance sheets. You don't understand anything of this crisis if you don't do that. Second, the fact that more or less when he was publishing his last book, he developed this analysis on the money manager capitalism. And this is enlightening, The neoliberalism he called money manager capitalism. But a lot of the things we are saying, he said. Third, the stage approach. The last Minsky resurrected a stage approach which has a lot in common with what you say, with what I say. That's why he had a relationship with Jim Croce, I think. The fourth, intellectual relationship. The fourth is the stress on limits of Keynes and Keynesianism. In my view, Minsky is very useful just to show the limits of the standard social democratic form of capitalism, standard Keynesian excess. The second point I was talking to that, I think, relates to a contradiction that I saw in your picture and what you said later on. Because in your picture, there was the great real crisis which was produced by the collapse of consumption and investment. And the great financial crisis which was due to financial institutions. But when you went into describing neoliberalism, you said that actually bubbles were useful in pushing up investments. Bubbles were instrumental in pushing up indebted consumption. These 2 things must have to do with financial institution, so you should have an arrow collecting finance to investment and consumption. In the later part, you have the part of the excess capacity. I like it. But here my criticism is the opposite. You have bubbles collapsing, and then you say excess capacity arises. I'm going very quick. Indeed, in my view, excess capacity was due to a new form of aggressive competition, Jim Croce again, and that was independent of bubbles. You see, I am a large, big service or industrial conglomerate. I go into Asia and I over-accumulate, I have excess capacity, so you will be forced, or somebody will be forced, to go out. So the interesting thing of excess capacity is that it is not linked to low demand in itself. Even if demand is high, even if there is overconsumption, there is a tendency to overcapacity in a new form of capitalist competition of big firms, big service providers, etc. I hope I was clear. Let's talk.
Yes, you were very clear. My knowledge of Minsky comes mainly from when I was in graduate school, and believe it or not, he was assigned in a macro course. So what I remember is his, what you call his canonical work. So I've been too busy reading Marx and haven't read Minsky, his later work. He is a very interesting figure. So you may be right. I don't think there's a contradiction to say that asset bubbles played a role interacting with the financial sector of neoliberal capitalism to promote these loan expansions, eventually leading to a crisis, while saying that the financial crisis did not explain the real sector crisis. That's the point I'm making. The arrow doesn't go primarily from financial crisis to Great Recession. I believe once the financial crisis occurred, it made the real sector crisis worse. But I think the initial causes of the Great Recession did come from the mechanisms that I described, which did have earlier arrows coming from the asset bubbles and the financial institution behavior. So I think I have enough arrows, but probably too many. But I think I need one more arrow on your last point, because I agree with you. Jim Crowder and I actually often confer about our work. I agree that I think one of the features of neoliberal capitalism is the transformation of competition. It's quite dramatic. And I think it does tend to bring excess capacity. So I think it's one more factor leading to excessive overaccumulation of fixed capital in the system as a whole. Although I think there are some problems with modeling that. I once did try to model how heightened competition would lead to excessive production of fixed capital, and was never able to get the model to work right. But intuitively, it seems right.
I'll go.
Well, I'm just trying to put together the last two stories. In both of the stories, in Jan's story and in your story, in terms of the emergence of the crisis, there's a collapse of the investment. Okay, and that's followed by the recession, which turns into a thing. But in your case, in your story, it's essentially triggered by the collapse of consumption. Whereas, as far as I understand in Jan's story, it's essentially triggered due to the capital market operations that the non-financial corporations were having, which they had difficulties in them, and then they cut their investment. And to me, it seems like this could actually be a sort of like more of an empirical question, in the sense that you could go to 2006, 2007, 2008, and look at what was going on in both fronts. And since this is a workshop, I think you should do that. You should probably work on it tonight, and come up with that story tomorrow.
Come back with
Or at least before the book comes out. Yes.
No, it's already in the book. I mean, I do have a...
No, we're talking about our book.
Okay. Now, we were discouraged from having too many tables or figures in this book, and I complied with that. But I do have a table in the book, which, by the way, will be only $39.95 because it's not being published with Routledge, which shows the exact timing of these quarterly changes in variables. And it is consumer demand that dropped first, and then investment demand began to drop and accelerate. So I didn't say that that the drop in investment demand was solely due to the drop in consumer demand, that there was also a direct link from the financial collapse and the asset bubble, from the asset bubble collapse to reduced investment, and then as the financial crisis developed, that also depressed investment.
Then you're going to need another arrow there, I guess.
Stavros.
Yeah. Yeah, the first point is the same with Thornton's. I got your explanation of the crisis as a form of modified or covert under-consumptionism in the end. That is, which in your general presentation, however, is negated. You argue that neoliberalism, that is a new stage or a new social structure of accumulation or a new regime of accumulation, whatever name we want to give to neoliberalism, suppresses some kinds of crisis, some types of crisis, and among them under consumptionism, and then you offer as a non-suppressed form of crisis an overaccumulation of capital, which in my mind is some form of modified under consumption. There is a credit expansion. Households borrow in order to cover to expand their consumption, and in this way the limitation, the lack of effective demand is somehow modified and is rectified, but in the end this goes out of control and the problem emerges. We have a steep fall in personal consumption, and then the rest follows, if I gather correctly from your argument. This is typical, not a typical, but it is another consumption explanation. And this does not suit very well with your argument that neoliberalism suppresses this type of crisis. It doesn't seem so. First point, this. The second point, the mechanism of the crisis, that is an overaccumulation of capitalism exhibited through an increase in capacity. And that somehow, at some point that goes well for a period of time, and at some point of time it goes out of control. It becomes suicidal. It expands more than it should be. Okay, why they are not regulating mechanisms? The obvious answer is that neoliberalism has thrown regulation out of the ship. But this begs another answer: is capitalism self-suicidal? Is capitalism self-suicidal in the sense that he has a solution to his problem, a form of organized capitalism, and he throws it out of the ship because
and I think,
I have a third point.
Finish.
Okay, and the third point is the following. You obviously imply that this is a structural crisis and it is an end of a regime of accumulation or of that of neoliberalism. And you define three possible alternatives. Let us leave socialism aside, and could you argue how nationalism, a form of authoritarian capitalism or a form of social democratic capitalism would solve this problem of overaccumulation of capital?
Before we turn to David, let me just point out, we have 10 minutes left. When David finishes his sentence, we want to leave him a few minutes to sum up. So in the wedge between David's two comments, if you have a question, make it or comment, make it very brief. David.
Okay, if I thought that underconsumption had caused this crisis, I would say so. I'm not sitting even closer to the door than I have, but I would not shrink from saying so. I think it's a possible cause of the crisis, but I don't think it was the cause. And overinvestment in fixed capital is not the same as underconsumption. Underconsumption, you can present a model of underconsumption with no fixed capital at all. It's not dependent on the existence of fixed capital. Fixed capital lasts for many periods, and this crisis tendency results from creating too much relative to total demand. And I think it's not the same crisis tendency, although they both involve, in the end, problems of demand, just like there are several different crisis tendencies relating to a falling rate of profits. I think there is no central regulatory mechanism in the neoliberal form of capitalism, and that explains why it produced such a huge crash, and some central regulation sprang up on the part of the state when this crash happens.
If you'll allow me, there seem to be a couple of people who want to ask some questions.
So I shouldn't answer the third part?
Then you can put all of them together at the end. You get them in. Al.
Real briefly, it picks up on the last two questions, but it's again the question of why do you call it a crisis? So you've got a bubble pop, both through the direct financial channels and the consumption channel. Demand falls off, investment falls off, and you end up with too much capital out there all of a sudden. And so they're going to invest less. But at the same time, you know that the profit rates have returned to the highest point ever. So my question is, what's the crisis for capitalism in this thing? I mean, I know there's still internal contradictions. It could blow up down the road, but that's always the case for capitalism. I don't see any patient lying on the bed about to die in any way. This could go on for quite a while. But they're pretty happy with the way things are going.
Okay, Ben wants to make a comment.
Nope.
Yeah, here you go.
Oh, there are two broad issues which are raised by your contribution. One is, have you described the US appropriately? And the other is it typical of other countries? And I just want to pick up on one thing in particular, and that is the idea that demand has been fueled, I'm not sure if you're putting it as extreme as this, by those who are unemployed or on low wages, who are deprived of the means to get health, education and so on, and they've resorted to credit, which has led to problems that you then described. Because it's my suspicion that that's not even true of the United States, and it's certainly not true of other countries, where the financialization of the household, if you like, is not driven by the poorest. It might be very characteristic of them, but it is not driven by the poorest households, but actually by the wealthiest households.
David, you have almost 6 minutes
Okay.
to deal with these.
Well, I'll work backwards. I never said that it was driven by the poorest households. I never mentioned the unemployed. I said the working class households, which are, about 60% of the U.S. population, borrowed heavily. They had to have enough means to own a home, which is probably about half of the working class. So those are the ones who are borrowing, not those at the very bottom. They couldn't borrow. And there is no evidence that it's just those at the very top who are borrowing. The amount of borrowing is way too large to have just been those at the very top. Although I should supplement this by an analysis of the borrowing by income groups. It's hard to find. The government doesn't collect data in this way. Why is it a crisis? This gets right back to the question of what a crisis is. The profit rate rebounded in the 1930s. On my view, I agree with what David Harvey's definition was. A crisis occurs when there's a large volume of surplus capital and surplus labor. Millions of people lost their jobs or lost their homes. And even if the capitalists are making high profits, I think this is going to generate increasing pressure to make a change over time. And that fits pretty well the concept of a crisis. It's going to force a change, not through automatic economic action, but through the combination of economics and politics. How can this lead to change, which was the third question I didn't get to respond to. A structural crisis like this creates pressure to change. And I've studied both how regulated capitalism was constructed after World War II and how neoliberal capitalism was constructed in the 70s. And eventually, there's pressure on key classes and groups to take action. And it's not a predetermined outcome. But one could imagine a big capital, a decisive group within big capital in the US and other countries deciding that they had to assert a stronger state role. And recently, in the last few years, there have been op-ed pieces by Fukuyama and another leading conservative thinker arguing that conservatives in the US have made a mistake to call for a small state. Capitalism needs a big state. And made a whole argument in favor of essentially a state-regulated capitalism, but aimed at building up the military. So there are signs of this, and also in other countries. And social democratic capitalism would emerge if there is a big increase in the strength of the working class movement, which one doesn't see in the US at this time, but it's certainly possible. So those are the conditions that could bring about change. If there's a real revival of the working class movement, that will open also the possibility of a transition to socialism. You know, surveys show that about a third of the young people in the US have a favorable view of, quote, socialism, whatever they might think it is. And I think there's actually grounds for hoping that there may be a real revival of the socialist movement under the conditions that we face in this crisis.
Okay, thank you. We'll stop 3 minutes early, and then we'll have a, when do you want to come? When would you want us to come back? Want to come back?
We have 15 minutes break again.
15 minutes.